overnight we have published a telco preview for the upcoming reporting season. And also as part of that, we've done a bit of a market watch, just letting people know how we're going with progress, particularly around the NBN. So I thought this morning I'd talk just a little bit about progress, about our 3 key picks, and then make some comments on a few of the stocks that I think are of interest to the network. So the NBN, we all keep hearing about it. I guess the important thing here is we're basically at the halfway mark. So in December, as in a month and a bit ago, 45% of households were on the internet. By June, it'll be over 50, so we will have made the halfway mark. So 1 in 2 households will be on the NBN by June of this year. Interestingly, so far Telstra's held its 50% market share on the NBN net adds. It's only just been the last quarter where they've dipped under 50%, and the last quarter probably coincides with the NBN rollout moving into the metro area. So Telstra's just starting to see the impact of some of its strong competitors, particularly in places like Sydney. What we've been keeping a really keen eye on in the sector has been prices. So we've tried to quantify what's been happening. These charts run back 12 to 24 months looking at prices per plans. As you can see, prices per both NBN and mobile plans are continuing to come under reasonable pressure. So it is a really competitive market out there, which shouldn't surprise anyone. And I certainly think that's broadly expected by everyone in the market, that it's going to remain intense. I think the key thing is telcos are not waiting for TPG to go hard on the mobile side of things. They're actually getting very aggressive on prepaid prices already. TPG will start trialling its mobile network probably mid this year, so that's going to hit the market soon, but the telcos, its competitors, are on the front foot, particularly there. So if I just jump into our key picks haven't changed from what we've been talking about the last couple of months. So number 1, Telstra; number 2, NextDC; number 3, Megaport. If I talk about Telstra, in terms of the result expectations, all the numbers are in this note, so I'm not going to go through them. Just point out 2 key things. Number 1, we are expecting a stronger first half for Telstra, and that's because in the second half we were originally expecting some big NBN one-off payments to come through, but obviously late last year the NBN delayed all of that, so therefore Telstra is not going to get a strong second half of payments, hence the stronger first half. The other thing to be aware, not a surprise, but this is the first time the dividend will be dropping to 11 cents. So they flagged that clearly a while ago, but just to be aware of. So why we think Telstra is a buy? First and foremost, the valuation we think is very cheap. We think it's very undemanding, and we think that makes the risk skewed to the upside, not the downside. We all know investor sentiment is very low. Everyone's pretty frustrated on this name, nervous about the impact of the NBN and competition. I think if Telstra gets through that, and as we make progress, history tends to tell us that people get really nervous. If you look at the Amazon experience, really nervous about what's going to happen, and then it happens and they realise it's not as bad. I think you'll see a similar thing with Telstra. So I think there's potential for it to re-rate. And I think around this result, they could talk a little bit more about cost out, because they do have a strong cost out program. And also Belong, which is their challenger brand, which they launched in the NBN a while ago, but have brought to the mobile market now. They've got some very aggressive plans in the prepaid end of town, and that's an area that they haven't actually operated in before. Obviously, Telstra's been a premium brand foremost. So if you look at the NBN, for example, they've now got the highest priced plan, which is Telstra, and the lowest priced plan, which is Belong. So they're really starting to flip the market and try and go very hard on that. And I guess the key risks for Telstra really are competition and NBN delays. Just in this note, I won't run through it now, but I thought it was interesting to have a look at the correlation with Telstra and 10-year bond yields. Everyone thinks Telstra is heavily correlated to bond yields. Depends where you look, basically. If you go back the last 10 years, there has been a strong correlation. If you go back the 10 years before that, i.e. 20 years ago, there was no correlation at all. So it's all over the place. I think that at the end of the day, earnings matter more and the environmental conditions matter more. But Telstra has historically traded about a 320 basis point premium to the 10-year bond yield in Australia and not been that correlated. If we move on, number 2, NextDC. This is a company that's got a really strong track record of beating and having positive news flow, I guess, at their results. If we look, they've got these new facilities coming online, B2 and M2. We know there's costs around that, so they are going to be a drag this year. So overall, we're looking for about, I think it's about $10 million of EBITDA growth. But behind that, you've got much stronger numbers coming through in the Generation 1 facilities, and those stronger numbers are being netted down as a result of costs on these new facilities. They obviously typically have a stronger second half as it's a growth company. and they've got guidance out there which I don't expect to be changed at all. But bearing in mind there are the AJD 360 costs that are not included in that guidance. So why this stock's a buy into the result? Well, firstly, I think people have forgotten about these new facilities. They're amazing facilities, these new data centres, best in Australia, and we think there's some real value in those facilities, and that will appeal to customers. We do think it's a high quality, well-run business, and we know there's substantial growth and continuing to accelerate in terms of customer demand. So this is a really well-placed company, well-run, and leveraged to strong structural growth. Key risks are the valuation side of things and APDC, resolving their disputes with their landlord. I acknowledge you probably can't see that, but just worth pointing out, basically the generation facilities are about 75% full now. So, over the last 5 years, they've pretty much got them full and making really good returns out of the Generation 1 facilities. The Generation 2 facilities are now online, at least B2 and M2. The Sydney 2 will be online this time next year, a little bit earlier. But the point of this is there's a potential now, as they fill the second generation facilities, for EBITDA in this business to quadruple. And if that happens, then we think you can easily get a valuation of around $16 per share versus a less than $6 share price now. So, there is significant upside on them filling the existing facilities, and we think, given the strong thematics, they will do that. The question is just how long does it take? And number 3, Megaport. They've already released their results, so we know what it's looking like. Interesting to see, last quarter was an acceleration, so the fastest percentage growth they've had probably in the last 18 months, so going well. What we're looking for at this result is how they're going in terms of progress in North America, by far the biggest market and just starting to get some traction. And then secondly, this Megaport cloud router, which they brought to market recently, I think has a very large amount of potential, so just getting some more detail around that. Why this is a buy? Look, it's a globally unique play, making significant progress, and we do think there's a lot of upside, particularly on North America, as that starts to hum along. And the 2 key risks for this company are competitive response. We keep a close eye on some of their key competitors. Interesting to note that Equinix, which is the world's largest data center operator, late last year launched a slightly competing product to Megaport, but only available in its, I think, about 5 facilities or something initially. So I would say it's not actually the same thing because it's only available in their data centers, but also that the CEO of Equinix, Steve Smith, who'd been running it for 11 years, I think, suddenly resigned just early this year. So, they're going to have other things to focus on, I would have thought. So not too worried on the competitive front. And obviously then the next challenge is accelerating revenue growth to reach profitability. I won't run through this now, but the point of this slide is just an illustration. So at the moment, in the last quarter, their revenue grew about 22% quarter on quarter. If it continues to grow, it needs to grow at about 18% per quarter to become EBITDA positive, and we think that's certainly achievable. And just finally, wanted to make a couple of comments on a few stocks worth drawing your attention to. 2 that we've got on holds are Vocus and Speedcast, and then I'll talk about a couple of the other ones. So Vocus, look, it's been a roller coaster ride, this company. I think it's getting close to getting resolved. The key for me is really these divestments. There's 2 assets they're trying to divest, and they've told the market they'll give us an update in February. I think there's a very reasonable chance that they divest their New Zealand business for quite a reasonable price and clean up their balance sheet. If that happens, I think the stock will have a run. If that doesn't happen, I think it's going to sort of sit where it is for now until they sort it out. So one to keep an eye on. The second one was Speedcast. It had been in our high conviction picks, and we actually pulled it back to a hold. We got a bit nervous when they suddenly made an acquisition halfway through a company transforming other acquisition. But if you look back, it looks like their timing was almost perfect on that acquisition. You've seen the oil price and the Baker Hughes drill rig counts start to accelerate. That's in the note if you want to have a look. But it looks like they've got their timing pretty right on that, and we're just very focused on the cash flow. So if they're able to deliver some good cash flow, that certainly warrants a second look. Superloop, something we've got to buy on. We're really looking for a strong second half performance here. We do think, as they mentioned in their AGM, they've had record sales, which is a positive, but they also mentioned there's quite a lot of integration work to be done on Big Air. So we're expecting particularly some integration costs in the first half to drive a stronger second half skew. And then just finally, quickly, over the wire, expect more strong organic growth. That's a high quality business. We've got an ad on that name as well. one we're happy adding to portfolios, noting that it's got a little bit of liquidity, so it's not for everyone. And then finally, TPG reports next month, and basically for them, it's all about this mobile rollout. They've got a huge CapEx cycle they're working their way through now, so it really comes down to the traction on that. So just in closing, our three key picks, Telstra, NextDC and Megaport, and two names that we're having a close look at this result being Vocus and Speedcast. Thank you.